business, that means that the income may be subject to a current income tax for the retirement account itself.
Mm-hmm.
And so we have this tax term. So sorry, folks, but we have to bring it up, and it's called unrelated business taxable income. And what it means is that entities like Roth accounts and IRAs are generally tax exempt. So if they have income from interest and from dividends, and if basically you buy these securities outright, then the account doesn't pay an income tax on it. That's why we talk about the tax deferral that you get from them.
Mm-hmm.
This tax exempt thing was designed originally mostly for charities, as I recall, and then
Mm-hmm.
they sort of extended it to retirement accounts. And so, but what they said is it's not fair for these entities to be able to compete with a business and not have to pay a tax.
Taxes, right.
So they came up with this structure that they call unrelated business tax, and what it means is that when these entities have business income, that they can actually be subject to a tax, and they file an income tax return in order to do it. The other thing is that is fairly common for real estate is people buy it using leverage.
Mm-hmm.
So in other words, they borrow money, they could get a mortgage, and so they'll put a small amount down as a down payment for the purchase of the real estate, and then they will pay a small amount of cash maybe, and then get the rest as a mortgage.
Correct.
So it's financed.
Mm-hmm.
When you have that mortgage financing, then any income that you have related to the part that's financed is also considered to be unrelated business taxable income.
Mm-hmm.
And then you've got rental income that could be taxable because of that.
That's correct.
On the other hand, the IRA or the Roth does get tax deductions for any interest that it pays and for the depreciation.
Correct.
Okay. And you may have a tax deferred exchange inside of a retirement account.
Well, that's one of the areas where we definitely, depending on the loan to value, you really want to determine, because the numbers may not work at a higher loan to value. So it's anything 75% and above, depending on the area and the type of property. The numbers may not work, especially once you factor in UBTI. So that's one of the areas that we will tell people to really make sure that they crunch their numbers, sit down with their tax professional and or financial planner advisor, and really look at the numbers to make sure, both short-term and long-term, that it does work, especially when you factor in UBTI.
Yeah. So, yes, you do need to consider that. And the thing is, though, that the reason why, as we said, that many people do it anyway is because, again, this is where the money is, and it's better to make some money and pay some taxes than not to make any money and not pay taxes.
Right.
So,
Yeah.
Okay.
Right, that's correct.
All right. So as a real estate investor, what things can you do and what things can't you do when real estate is held in an IRA or Roth account?
Well, you, as the account holder, where there's a list of disqualified parties or disqualified persons in accordance to IRS Code 4975. And what that basically states is that you, as the account holder, your spouse, parent, grandparent, children, or grandchildren cannot live in the property, cannot basically have any personal gain or any type of relationship with the property. So basically you're prohibited from doing any business with those list of relatives. There's also a list of parties that's also disqualified: an employer of a plan, fiduciary, and a few others as well. So it's really important to understand who you can and cannot do business with as it relates to a self-directed IRA.
Yeah. So this is getting into the area that we call prohibited transactions.
Correct.
And so again, when you're investing in real estate in your retirement account, like an IRA, what it means is that it can't be for your personal use.
It can be for personal use or the use of any disqualified party.
Right. So you're not getting a vacation home here.
And it's not can't be a home that you're buying to rent out to your daughter or son who's in college.
Okay.
That's usually where you're going to run into problems.
Yeah. Okay. So what are some Are there any other disadvantages maybe that we want to highlight related to investing in real estate in an IRA or Roth account? Or?
The disadvantage in terms of real estate is really to understand where you're at in terms of, are you getting close to that required minimum distribution age? Because it's really important, if you're going to hold an asset such as real estate, that you have liquid cash to take care of your required minimum distributions. At 70 and a half, you're required to pay Uncle Sam his portion in terms of tax revenue. So it's important that you have either some cash flow coming in or monies from another retirement account to be able to satisfy that requirement annually. That is one of the key concerns, or should say one of the key things that one should take a look at before they invest in real estate, especially as they're getting later in their ages.
Yeah, so that is a big concern. So you're required to annuitize your account when you reach age 70 and a half, and so you have to have the cash to make the payments.
Correct.
And there is another thing that just came to my mind, one thing, and that is that long-term capital gains. So if you hold real estate outside, and this has to do with the difference between a Roth account and a regular IRA account, when you pull money out of a regular IRA account, that's taxed as ordinary income.
Correct.
And so that means that what could have otherwise been taxed at a long-term capital gains rate may be taxed, in fact, as ordinary income when you take the money out at a later time.
Which could be lower.
Yeah. So again, just recognize that you're making a choice. And again, it's because this opportunity may not be available to you outside of the account because you just don't have the cash, and here you got it. So again, it's better to make some money and pay some tax, maybe a little more tax, than not to make the money at all.
Correct.
There is another thing, and that is getting access to the cash in the retirement account. So it's pretty restricted as far as you're being able to draw out the cash from the account until you reach age 59 and a half.
Right. Especially when it comes to real estate, or even, well, just the account as a whole. I mean, you're restricted to take any form of a distribution prior to 59 and a half. One, you're going to be taxed in addition to the 10% early distribution penalty. If you have a situation, one of the questions that will come up is, if I need cash out, and it's being held by, all of my funds are tied up in a piece of real estate, how do I get cash? That's also where non-recourse loan comes into play as well, because non-recourse loan can be used for both acquisition as well as a cash out refi. So once again, as long as the LTV or the loan to value guidelines are met as it relates to whether it be an institutional lender or a private lender, that is an option as well.
Okay.
Because that's usually one of the questions that will come up, especially when we're kind of trying to battle in terms of getting the clients trying to get monies from their traditional IRA to move over to a self-directed IRA. The question will come up, well, what if you run into a problem for is liquidity? If you need cash, if you go that route, you're kind of stuck. So that's one of the options that we convey to them that's available to them if they have to liquidate.
Okay. So can an IRA invest in a partnership with other entities for real estate? What are some structural alternatives? What are some different ways that you can make real estate investments?
Well, you have an option, depending on how many transactions you're going to do and usually what your short-term and long-term objectives are going to be. The least expensive method of partnering would be a tenants in common, or a TIC, where you can actually partner with various parties, including other disqualified parties to some extent. And it's, once again, it's the least expensive option. And then, of course, the other option would be through a single member LLC, or should I say a multi-member LLC would be another option.
Yeah. So, or you could have a single member LLC in some cases. That may be a good alternative.
Right, but you just wouldn't be able to partner in a single member LLC.
Right. Then you wouldn't have a partner per se. Okay. So maybe, could you tell us maybe some examples of some of your clients and some of the types of real estate investment programs that they've done? Maybe you thought of one or two interesting cases?
I would say the first, I would say 2008, 2009, there was a lot of buying and flipping. And it got to a point where the profit margins got thinner and thinner. It got to a point where when they took away the tax credit for first-time home buyers, that really had a lot of investors stuck because they, for whatever reason, didn't think it was going to have an impact on them turning the property. So now what you're beginning to see is a kind of a combination of buy and hold and buy and flip. And they're basically holding their properties longer, once because, and of course it's really important that if you're going to go with the buy and hold, that depending on how you structured your deal, that there's no leverage definitely, and then two, that you're not going to get close to an age to where you're going to need that income to live off, but it's tied up in a piece of property. The more common transactions I'm beginning to see now is I'm working with a lot of groups, whether it be syndications, private equity groups, where they're basically raising capital, whether it be private as well as retirement funds, and they're going and purchasing bulk real estate owned properties or bulk deeds of trust directly from the bank and or from the FDIC. I'm seeing a lot of that because what's happening is, once again, the profit margins, especially in a buy and flip model, the profit margins are really, really thin, and in order to get around that, you have to buy in bulk. Like with anything else, you're going to get a deeper discount. So that's what I'm seeing a lot of, and that's where a lot of clients, there's some pros and cons when it comes to going that route, especially if you're going to be investing into a fund. It's really important that you perform your due diligence, because there are a lot of scams surrounding in the area of syndications and funds.
Yeah, I mean, after all, this is your retirement account that we're talking about here, and it would be a shame to see that. So, and actually, I have seen situations, where deals have fallen apart. We've had some of these exchange companies have gone away in the middle of an exchange transaction, and so forth. And so you need to be very careful about what you're putting in to these accounts. I heard of one case from another person that I thought was kind of interesting. A person bought a home that they decided that they wanted to retire in. They wanted to live there after they retired. So basically, they bought this property and they started renting it out. I believe it was in a vacation type location, and so they were able to get some pretty good rents in the summer seasons and so forth. And then after they retired, they bought it in a Roth account.
Yeah.
Okay. So then after they retired, they distributed the house from the Roth account tax-free.
Tax-free. And that's, I'm working with quite a few attorneys to where that's kind of an investment strategy, especially for a lot of baby boomers who are looking to retire soon. And of course, unlike maybe 40, 50 years ago, one obstacle that a lot of people are facing right now is a huge mortgage, and that's not going to be sustainable on a fixed income. So what's happening is a lot of clients are basically opting to use the retirement funds to buy that retirement home. That way they know that on a fixed income, not to mention especially if it's done in a Roth, they don't have to worry about the taxation, in addition to whatever or fixed income they have will sustain them, because once again, they own a property free and clear. In the meantime, they're growing that IRA, that Roth IRA, prior to then moving into it. So that's an excellent strategy.
Okay. All right. Well, Lamar, we're about out of time. Maybe there's a final word of wisdom you'd like to throw out?
Do your homework. Like I said, this is not for everyone, but I advocate this type of investment vehicle because I believe in basically empowering people through being proactive and taking control of their investment. Yes, get your financial advice, but at the same time, be in a position to have power in terms of knowledge, in terms of what you're investing in, to be in a position to check over the shoulder of the person who's managing your money.
Okay. All right, folks. Well, we're all out of time. So we want to thank you for joining us today on Financial Insider Weekly. Lamar, thank you for being my guest.
Thanks for having me.
And we hope that we've given you some good food for thought here that you can investigate further. We'll see you next time on Financial Insider Weekly.